for the macro perspective. The view here is that the GDP in China will expand faster than the United States, and a lot of investors are kind of shaking off geopolitical tensions on the back of that theory. Do you see the same promise that the China bulls are seeing?
I do not. I was in love with China until about 6 or 7 years ago. You go over there and the energy in Shanghai was like New York on crack. I mean, it's just fantastic energy. The entrepreneurs were exciting. They were into it. And then Xi Jinping did his thing. And if you look at China and the rise of China, I think it all sort of happened. You had this internal capitalist system with a bunch of people that act like crazy New Yorkers, building new businesses in a dynamic economy. But he has proved he's not a capitalist. He's definitely not a monopolist. There's only room for one monopolist in China in his mind, that's him. Anybody that gets their heads stuck up. And I honestly think he either doesn't understand why China grew and succeeded the way they did, or frankly, he doesn't care, because in terms of staying in power. But I would be looking out 10 or 15 years, I just don't see it. Unless there's a change in power there at the top, I think that's going to be a very undynamic economy. It's not so much the geopolitical concerns. I will say this, that if I'm right, it makes me more fearful of military action, because that's when dictators become more dangerous, is when they've got to divert attention from the immediate problem. So what they're doing now is very stimulative. We're expecting a sugar high and some kind of robust growth there, maybe for 6 to 9 months. But looking out, I do not look at them as a big challenger to the United States in terms of economic power and growth.
Really powerful words there from Stanley Druckenmiller, legendary investor, in conversation with Sonali Basak at the Bloomberg Invest Conference. Just to wrap up some of those thoughts, aside from China, with a lot to say there about the outlook for that country and its leadership. I'm more worried about growth than I am inflation. I don't know when the recession comes. I expect it to come, though, at the end of the year. Then that conversation there on AI. I believe, unlike crypto, AI is real, could be as transformative as the internet. If staples go up in a recession, he made this point, why can't NVIDIA? On NVIDIA, really important here about time horizon, how long he wants to stick with this trade. If this thing is real, this isn't a 10-month move. If I'm right on AI, NVIDIA is something I want to own for potentially 2 to 3 years, or maybe even longer. We're going to build on this conversation in just a moment with Savita Subramaniam of Bank of America. Just to get your attention on where the price action is right now, about 1 minute into this session, the S&P 500 shaping up as follows. On the S&P, just slightly positive on the S&P this morning. We're higher by 0.1%. The Nasdaq positive as well by 0.4%. Outside of the equity market, if we shift gears and go to the bond market just briefly, Treasury shaping up as follows. On a 2-year, a 10-year, a 30-year, the 2-year higher by about 5 basis points to 4.53. On a 10-year maturity up to about 3.71. One stock to watch at the open is Coinbase. Shares rebounding after a 12% drop following the SEC's lawsuit against the crypto exchange. The CEO, Brian Armstrong, tweeting, quote, "We're proud to represent the industry in court to finally get some clarity around crypto." Abby has more. Hey, Abby.
Hey, John. Well, it's interesting because those comments that you were just talking about from Stanley Druckenmiller imply that he thinks crypto is not real. Now, this stock in some ways would actually imply that it may not be real, given the fact that from its peak, it's down 89%. Today, though, it is popping up 1%, a modest pop, especially given the fact that it was down sharply on Monday in sympathy with Binance and the SEC suing them. And then yesterday's lawsuit against Coinbase down that 12%. So net down about 19% this week, despite today's pop. Now, of course, at issue is Gary Gensler, chair of the SEC, saying that crypto is no longer going to be a wild, wild west, that tokens should come under the purview of the SEC, and that staking is illegal. The idea that this is an illegal exchange, that they're taking fees from people to use their crypto in blockchain transactions. A lot more ahead here, but right now this stock, a lot of pain. Again, John, it is up 1% on the day, but from its peak just a couple of years ago, down 90%. This week, down about 20%. And there's a 25% short interest. So Stanley Druckenmiller talking about shorting and how it can be fun. Maybe some of these shorts are having fun.
Fun, but sometimes painful as well. Abby, thank you. Just a programming note, don't miss this conversation. Coinbase CEO Brian Armstrong tomorrow, 12:30 Eastern Time, with the team over on Bloomberg Technology. Speaking of tech, Netflix shares higher as analysts boost their price targets. Wells Fargo out with a street high number of 500, highlighting an upside potential from ads and a password crackdown. Katie, a password crackdown which seems to be hitting a lot of people.
A lot of people, but it's good news for Netflix. I mean, Wells Fargo saying that basically the TV ad marketplace should be, quote, easy pickings for Netflix's ad-supported tier. And then you have JP Morgan really honing in on that password sharing note. They say that there's probably 100 million password shares out there globally, and that Netflix ideally would be able to monetize about 33 million of them by the end of 2025. That obviously would be good news for Netflix, and that's why JP Morgan also boosted its price target today to $470 from $380, so about $30 below that new street high from Wells Fargo. So we'll see how this comes to fruition, but that's a big vote of confidence, and you can see it in the stock today, currently up about 4.5% or so. For the year, Netflix is up over 40%, so that's outpacing the broader NASDAQ 100 by just a little bit.
Our pain. Their gain. Katie, thank you. That stock up by 4.5%, as Kenny pointed out. Sticking with tech, Tesla seeing a boost after its Model 3 sedan to become eligible for a $7,500 tax credit. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla up for a 9th straight day, its longest streak of gains going back to January of 2021. That stock trading at its highest level since November 2022. All of Tesla Model 3 sedan variants are now eligible for the full $7,500 tax credit. That was posted in an update to the US Treasury Department website, government website. What's curious about it is what's happened to make them eligible. We don't have any indication of that. Tesla started advertising the full availability of the credit among the Model 3 variants before that update was made public by the government. One analyst, George Giannakaris of Canaccord, hypothesizes that the company may have moved production of lithium iron phosphate battery packs to the US from China in order to give eligibility to what is the second best-selling EV globally, right? Model 3 was the best-selling model in 2021, but the Model Y, the sort of small form factor SUV, has overtaken it. Even so, this is kind of an important development because prior to this change by the Treasury, only the higher spec performance version of Model 3 was eligible. Anyway, it's clearly adding to gains on this stock in this morning's session, John.
Stock up 2.6%, there and thereabouts. Ed, looking forward to the conversation with Coinbase a little bit later. Catch that again at about 12:30, so about 3 hours from now. I want to turn to the chip makers. The Philly Semi-Index climbing into day 2 with NVIDIA leading the crowd. Kelly Lyons has more. Hey, Kaylee.
Yeah, another day of outperformance for the stocks here, John. The index as a whole up about 0.8% at the moment. You continue to see leadership coming from some of these names. Of course, we saw a big rally yesterday for the likes of AMD, which was had its price target raised at Piper Sandler on an AI play. Intel announced that it was selling some of its stake in Mobileye, reaping a $1.5 billion reward off the back of that. So we saw pretty big gains for those stocks yesterday, continuing this morning with AMD and Intel, each up about 0.6%. But as you said, a little bit about performance from NVIDIA here, up 1.7% after it was actually lagging over the previous couple of days. Again, AI is the name of the game here, as we were just hearing from Druckenmiller himself. And then I wanted to point to Marvell Technologies as well. At the moment, up about the better part of 5%. This is after a report from the Liberty Times, which is based in Taipei, reporting that Marvell won a contract for Amazon's second generation AI inference ASIC chip. They didn't say where they got that information from, but clearly traders are trading on it. That stock now up 5% or so, John.
Kelly, thanks for that. I just want to pick up on Apple as well. The year-to-date gains close to 40%, up today in early trading by something like 0.75%. Wedbush raising their price target on Apple from 205 to 220, trading currently at about 180. Dan Ives writing the following: Apple's fair valuation could be in the $3.5 trillion range with a bull case, $4 trillion valuation. By 2025, he's still, and he's been looking for this for a while, looking for a big upgrade cycle going through iPhone 15. That stock is up by 0.6%, massive year-to-date gainer. Big tech just getting even bigger this year, and the warnings about narrow leadership continue to build. Bank of America's Savita Subramaniam writing, Apple is now bigger than the Russell 2000. 7 stocks drove year-to-date S&P 500 gains, all tech or tech adjacent. We appear to be in the early stages of a shift in leadership from from new economy disruptors to capital-starved, now disciplined cyclicals. Savita, I'm pleased to say, joins us right now. Savita, why can't Apple just get bigger? Why can't those 7 names just get bigger? Why does this have to change?
Yeah, I mean, I think that we're at a point where a lot of the levers that drove mega cap tech to its, soaring weights in the S&P 500 have at least stalled, if not reversed. I mean, I think it's going to be a very stock-specific leadership cycle. So I think some big cap will do well, but others won't. So here's the deal. If you look at the multiples of technology and communication services companies over the last 10 years, they are the most correlated with the Fed balance sheet. And I think that's the risk, is that we've had this environment where, sure, these are great companies, but they've also been the beneficiaries of massive liquidity, falling interest rates, supporting valuations because, for growth stocks, low discount rates are a bigger boost. I think some of those macro trends are poised to at least pause, if not reverse. I mean, look at the Treasury, look at the 10-year Treasury. I think what's nerve-wracking right now is that the idea of a 60-40 allocation in stocks versus bonds, the S&P 500 and bonds basically did the same thing for the last 10 plus years. So that's where I would be worried about mega cap tech and a lot of the, the sort of low interest rate beneficiary leadership in the market. That said, I do think that there is a really interesting theme that one can play in terms of old economy stocks actually becoming more efficient via technology. So think about it. We've been in an environment where companies haven't had to spend on productivity or efficiency because everything's been so cheap for the last 10 years. You can get cheap labor, cheap, input costs, et cetera. And then you had COVID, which reminded us of inflation and, kind of the benefits of being efficient, the benefits of managing costs. And I think that's where we see a lot of these, old economy service sectors potentially getting better.
Yeah.
I do think some AI plays are worth, paying attention to. It's tough to follow Druckenmiller. He's very smart, but I think, and he's 100% right about AI. You can't short it. But they're not all going to be winners, and I think that's where you have to listen to our fundamental team on who's going to win and who's going to lose. But, John, I wanted to mention we are hosting, in about an hour, we're hosting a conversation with a professor who's done work on how AI can basically replace professional investors. So this is a real theme. This is a real threat to jobs around the world. It's a positive for productivity. I think it's something that, we just can't afford to ignore.
Well, Savita, let's build on that. You mentioned Stanley Druckenmiller. For those of you just tuning in, Sonali Basak in conversation with the legendary investor, talking about AI and one stock in particular. Take a listen.
If Staples can go up in price in a recession, why can't a company like NVIDIA, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that NVIDIA goes down despite the lofty valuation level.
Savita, choosing not to short them is one thing. Can you choose just not to be in them right now?
Yeah, it's a great point. I mean, look, tech is complicated. You can't ignore it. U.S. tech is the biggest sector in the world. So I think it's really about picking your spots. And here, again, I would look at companies that have thrived in an environment of cheap capital, and that was their biggest, kind of growth story. Those are the companies I would be shorting now. And, we see them in the consumer sector. We see them in communication services. We see some in technology. But I think when you look at companies that are, CapEx takers around this AI cycle, I think it's hard to say that these are companies that have just benefited from low interest rates. These are real companies with real growth stories. And the trick is to figure out how much you want to pay for that growth and whether that is sustainable growth or whether this is, a competitive industry where that could be whittled away very quickly. I think the one benefit for mega cap tech is that, the regulatory landscape looks a bit trickier today than it has in the past, given, cyber risks, data privacy, real populist problems that are affecting the man or woman on the street. I think their mega caps have a leg up on micro or mid cap tech because they have deeper pockets, they have the ability to shoulder more compliance and legal costs, and at some level, regulation provides a moat around an industry. So I think that's one benefit of mega cap tech that, again, you can't ignore. But if I were going to pick my spots within the S&P 500 where I'm going to get the most bang for my buck, I think I would go for companies that haven't really gotten efficient but now have the opportunity to replace labor with automation, replace, rote processes with AI and machine learning. I think those are some of the areas where we're going to see monstrous restructuring, big sustainable margin expansion. I mean, I think this could be a really interesting theme for old economy sectors in the S&P 500. And oh, by the way, nobody owns any of those stocks. Those stocks are trading at dirt cheap levels. Old retail, kind of when you look around and you look at the disruptees versus the disruptors, you can still find inefficient companies that have the ability to get much more efficient over the next 5 years and are actually spending the money and have the tools to do so. So I think that's one of the really exciting themes within the S&P 500.
Savita, always wonderful to get your view on this equity market. Savita Subramaniam there on the equity market, who recently upgraded her outlook on the S&P 500. A bias though for the equal weight and looking for those other things to start working. I just feel for a lot of people it's one or the other. You're either in cash at 5% or you're chasing hopes and dreams in AI, NVIDIA. That call from Stanley Druckenmiller, not just a 10-month trade, could be a multi-year trade and even longer. We'll pick up on that through the day here on Bloomberg TV. About 15 minutes into the session, equities advanced by 0.3% on the S&P. Coming up, a growing chorus of concerns over weaker growth.
This is an economy where lags are likely longer than they have during prior cycles. We do expect to see more signs of an economic slowdown.
That was Dan Iverson of PIMCO. Up next, just a flavour of how Stanley Druckenmiller sees the outlook for growth. That's next.
if you look at China and the rise of China, I think it all sort of happened. You had this internal capitalist system with a bunch of people that act like crazy New Yorkers, building new businesses in a dynamic economy. But he has proved he's not a capitalist. He's definitely not a monopolist. There's only room for one monopolist in China in his mind, that's him.
Famed investor Stanley Druckenmiller there, not exactly enthusiastic about leadership of the world's second largest economy, China. PIMCO not exactly enthusiastic about the outlook either, looking for downside risk to growth, upside risk to inflation. The OECD backing up that view, looking for a weak global economy plagued by inflation.
We expect global growth to moderate to 2.7% in 2023 and then edge up slightly to 2.9% in 2024. These are historically low numbers for the global economy. We've seen higher rates in the past, so the outlook is certainly without change and without action. The outlook would be for global growth to return, but to be at weak levels.
Mike McKee, just how grim is this?
Well, this is kind of dog bites man. I mean, there's no special insights in this forecast, no surprises. Both the OECD and the World Bank saying what most Wall Street and other economists have been saying for quite some time. We're going to have a global growth slowdown. The question is, does it fall into recession territory? The OECD, you could call them the cockeyed optimists. You showed the numbers there, 2.7% this year, 2.9% for next year. The U.S. gets some growth this year, slows next year. Europe slow all around. Now the China question, they see China meeting its growth target this year, 5.4%, 5.1% in 2024. The World Bank, those are the pessimistic folks. They said yesterday they're marking down their growth for the world to 2.1% from 2.7. They're also more pessimistic about the U.S. and Europe. They're more optimistic about China this year, but not next year. What's to be done? Well, both organizations say central banks must continue to fight inflation, but they must also take care not to put their economies into recession. That's not going to impress a lot of people. What does it mean? Not a whole lot. The central banks will decide for themselves. Next week we have the Fed and the ECB. But here's something interesting. The Business Roundtable out with their latest CEO forecast, and the CEOs are much more optimistic, it sounds like, than either the OECD or the World Bank. They see capital expenditures growing, sales growing, and employment increasing or staying the same by wide margins. So we'll have to see who's right, the economists at the world organizations or the CEOs in the C-suite who have to make the spending decisions.
Take your pick. Mike McKee, great summary there. Mike McKee there on the global economy, the difference between leadership at a C-suite level and what you hear from economists right now. This is what we hear from the market at the moment. I can bring you the scores. On the S&P 500 up by 0.3%. On the Nasdaq about 22 minutes into the session up by 0.6 with some sector price action. Back with us, here's Abby.
So a relatively small gain there, John, but we have something going on that everybody has been wanting to have happen, in fact saying is going to happen. At least that's what Alon Rosen of Oppenheimer told us, and that's good breadth from a sector standpoint. We have most sectors higher at this point, led by energy up nearly 2%, consumer discretionary up almost 1%, communication services, materials, tech, real estate, industrials. To the downside, we have healthcare, financials, and staples all down less than 0.5%, so a bit of a risk on session. What I'd like to point out is we have this breadth maybe creeping in this quarter. On the quarter, take a look at those mega cap tech indexes, all up 10% or more, but we also have the financials creeping higher, John, over the last 2 months, up 2.6%, something to keep an eye on.
Really close to the year-to-date high, the index level. And Abby, thanks for that breakdown beneath the surface. On the S&P 500, the year-to-date high, just a couple of days ago, 42.99, 42.99.28. Right now, I can tell you the high of the session, 42.99.19. So like that far away, just short of it right now at 42.97. Coming up, your trading diary. Some outperformance in the Russell this morning, up 1.5%. Elsewhere, a bit of a snooze on the S&P 500, up by 0.25%, about 26 minutes into the session. That's the price action. Here's the trading diary. Coming up, a Bank of Canada rate decision, top of the hour. President Biden welcoming Prime Minister Sunak to the White House at 11 a.m. Then another round of jobless claims coming up on Thursday. Looking ahead to next week with CPI on Tuesday. Then the big one, the Federal Reserve decision coming up on Wednesday. A hike or a skip? I think a lot of people leaning towards the idea they communicate a skip. No hike next month, but open to the idea they can make a move again. We'll talk about that tomorrow. From New York, thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, June 7th. Here are the top market stories we're following for you at this hour. Kravis, Druck, Chavez, Armstrong. We're going to take you live to Bloomberg Invest to talk to heavy hitters and get their take on the markets, AI, the economy, and more. And is it too good to be true? The VIX hits a 13 handle overnight, the lowest since February 2020. Stocks, though, push higher. Energy, discretionary, small caps all leading the way. And pause to hold to hike. You got Bank of Canada rate decision breaking right now after a conditional pause since January. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. He's back. Welcome to Bloomberg Markets. Guy, Bank of Canada, what do you got?
Something exciting out of Canada, Alex. They raised by 25 basis points. Very few economists had anticipated that this would be the case. That is the case. This is what we have. Rates go from 450 to 475. The estimate, as I say, was that we were going to stick at 475. That's a 25 bip point hike. The RBA's done it. Canadians have done it. Who's next? Are we going to see a pause from the Fed? Are we going to see a hike from the Fed? Are we going to see a July hike? I don't know. Look, I wonder if there's something we can read across here.
Yep, and there you look at it, the currency market, you have the dollar dropping like a stone, you have the Canadian dollar kind of popping higher. Is it set the stage, though? Just because you pause or hold or skip doesn't mean you're done with your tightening cycle. We do want to take you now to the Bloomberg Invest panel in New York City. Henry Kravis, KKR co-founder and co-executive chairman, is talking with Jason Kelly about the state of the economy.
And I would imagine that leads to a decidedly not robust deal-making market. Is that fair to say?
Pretty quiet. You know, if you think about it, Jason, today you've got a look back at 2021, say July 2021. You had high yield, IPOs, and private credit, or credit, not private credit, at about 8.5% of GDP. Today, April was about 1.3% of GDP. So what's happened is you have a much tighter, capital market. That just makes it tougher to do deals. Having said that, the private credit market is very strong right now, and people like KKR and others that have a large private credit business, we're able to fill the gap and do things. Secondly, we bought several companies that we just did all equity, and we'll finance later when rates come down, and we've got plenty of equity capital. We'll buy them with equity. And so what you're going to see, I think, is a sustained period of time where the capital markets will stay tighter. It is not, to date, a credit issue. Could become a credit issue, but it's not there yet. It's more of a liquidity issue right now as to why you're not seeing as many private equity deals done.
I want to get in, based on what you just said, get into a little bit of the guts of KKR, because what you just described is a very different firm from what you and Jerry Kohlberg and your cousin George Roberts started in 1976. 95% of the money that you raised last year was not private equity. It was all in those areas that you described and more. How would you describe this firm right now?
Well, I think you have to go back a little bit and understand the most important conversation that Jerry, George, and I had in 1976, and that was, what kind of culture did we want to have? And it was very important to us to have a culture where everybody was included in everything we did. That meant that everyone was paid for and got part of the carried interest, part of the fee income, because all we did when we started was private equity. Whether you worked on a deal or you didn't, whether you were a partner at the firm or you were not a partner at the firm. Fast forward 47 years, we have 26 offices around the world, maybe 40, 45 different products that we have at KKR today, ranging all the way from every kind of credit product, infrastructure, real estate, private equity, growth equity, et cetera. And today it is exactly the same culture. Everyone at the firm gets to participate in everything we do. So that means that if I came in to see you and you're the CEO of a company, it used to be all we could talk about is your company for sale. Today, let's get to know you. We are very big believers that people do business with people they like and trust. And so build a relationship, and that's really how we go about it. And then eventually you find out, because everyone at KKR has a toolkit, they find out that, wow, this company needs to redo their balance sheet. This one wants to make an acquisition, but they don't have the banks covering them anymore because we're in a tighter credit situation, et cetera. We're able to provide capital up and down the capital structure. So yes, that is correct that last year, about 95% of the money we raised, which was somewhere in the $75, $80 billion range, was non-private equity. And the reason for that was we had finished raising large private equity pools of capital already. So that money was used for climate, for ESG, for real estate, for credit, all kinds of credit, and for infrastructure. So today we're a very diversified firm, able to be a solutions provider to many companies anywhere in the world. And that's really was by design what George and I and Joe Bay and Scott Nuttall really worked on over the years.
One of the interesting things that you've gotten into, and Joe Bay, the co-CEO, talked about this a couple weeks ago or in the last week or two, was getting into the high net worth area, a new fund related to that. I mean, this has long been the holy grail, a holy grail for folks in the alternative investment business. Talk about that opportunity, if you will.
Jason, that's a huge opportunity. First of all, in the high net worth area is about $178 trillion of capital, net worth, income, et cetera. Today, 1% of that is in the alternative space invested. So think about that. If you just got to 3 to 5%, what does that mean? That's trillions of dollars that will be able to go into the alternative space. When I talk about alternative, what I'm saying is that's private equity, that's infrastructure, that's real estate, it's maybe private credit, et cetera. And so we have come up with democratized products across the board here. We're working with different registered advisors and getting on different platforms to sell these different products. This is fairly new for us, but initial reaction so far has been very strong. Because if we'd had this conversation 10 years ago and you said to me, do you think that KKR will ever be dealing with the high net worth population? I'd say, yeah, in a small way. But today, we're now able to deal with the high net worth population globally in a very major way. And that's going to change the complexion. These are pools of capital that will, be fairly well tied up for 5 years at least, if not longer. And we're going to, I hope, take advantage of the opportunities there today.
So one of the things that's going on at the firm, you're now a year and change, I believe, into a pretty major transition, which is your job has changed. You and George handed off the CEO roles to Scott Nuttall and Joe Bay. So what's your job like now?
Well, first of all, I'm glad after 45 years to finally get promoted. So I'm really happy about that. So George Roberts and I, we both founded the firm with Jerry Kohlberg. And for 45 years, George and I were co-CEOs. And we're now co-executive chairman. We meet officially once a week with Joe and Scott. We help them think through strategy. They're running the business. This is, given to them. And by the way, this took a lot of thought on George's and my part. We didn't wake up one night and say, okay, let's just pick some people out of the air. We actually started with about 7 people that we thought possibly could do the job. Narrowed it down to 3 people. That was over a 7-year period. And what we did then was to make Joe Bay and Scott Nuttall co-chief operating officers in, I believe, about 2017. George and I stayed as co-CEOs, and we kept giving more and more responsibility to them. Let's see how they do. And they did a phenomenal job, particularly during COVID there. The firm grew dramatically during that period of time. And they performed magnificently. They showed real leadership. Now, picking 2 people, I've heard over and over again, 2 people never work. Yes, we've got lots of examples where 2 people don't work. At KKR, George and I grew up together. We're 4 months apart in age. We met when we were 2. We're first cousins and best friends. And that's the best partnership you could have. So what we saw in Joe and Scott was the fact that they came into the firm together probably 26 years ago now, grew through the firm together, and their families are best friends. But there was one piece that we focused on very much. Obviously, they've got capability of leadership. Did they believe in and live by our culture? And that was critical, because if we lose the culture at KKR, this culture of inclusion, everybody participating, we lose our DNA. And they live by it. And so that was a very important part. George and I have always believed that if you, because we're often asked, how did you make it work so well? And by the way, you two must fight a lot. Oh yeah, we had, I think we had a terrible fight. We both were 7. And he wanted to ride my new bicycle. He had just come up to Tulsa from Houston for Christmas. I got in his new bike. And I got chased in the house because I wanted to ride the bike first. I wasn't a very good host. And I ran in the corner of a wall and cracked my head open, and I had 26 stitches. That's the last fight we've had. There's no reason to fight. Go bust your head open. So we...
who says Wall Street isn't a contact sport? Come on.
That's right. So in Joe and Scott, we saw many of the same characteristics and same friendship and camaraderie with their families and the two of them that George and I have. And so it became pretty natural for them to then succeed us. But, you know, we built this over a long period of time because we always said we wanted a firm that survived long after George and Henry were gone, and it contained the same DNA that we've been able to build for many years in the past.
One of the things I always like to ask you about is New York City, because you've been a steward of this place since you came to Columbia Business School back in the day. You've been very involved from a civic, philanthropic, and obviously business perspective. What do you see in New York City right now? You've moved to Hudson Yards. The firm is now located there. What does New York City feel like at this moment? You know, wildfires notwithstanding.
No, I worry about New York, and I think it's going to take a long time, because we have something today that we didn't have before, and that's the aftermath of COVID, of just getting people back to work. Now, I'm happy to say that at KKR, we got people back about 2 years ago, and what we said was, we're an apprentice model. People learn from each other, so we expect you to come back in, and they did. Now, it didn't hurt in New York, for example, the fact that we had a brand new office, we had great food, and people wanted to be together, and you learn from each other. One of our biggest challenges in New York, and the challenge for Mayor Adams, is going to be to get people back into the office, and that's going to be tough. It still isn't happening yet. It's better than it was. So that's one worry. The second worry that I have is just crime. You know, I wish that the mayor and others in the government could figure out a way to be much more focused on penalties for people that commit crimes. You can go into stores and take up to $1,000 and not much happens to you. If anything, that's wrong. And so we've got to, I think, start getting tougher on crime. And it's like the broken windows theory. You know, one window gets broken, another gets broken, pretty soon the whole neighborhood's gone. Well, that's what's happened here in part. So I think this whole turnaround of New York, it can happen. I love New York. I've lived here since 1967 and coming from Oklahoma, but I think it's just going to take a long time to get back to where we should be.
All right, well, as we start to wind down a little bit, I have to ask you about a very important topic, golf. You're a very good golfer. I know that from a number of people, including my boss and your friend.
Don't believe everything you hear.
You're a deal maker. We saw a hell of a deal yesterday putting the PGA and LIV together, at least on a commercial basis. As a deal maker and a golfer, what do you make of it?
Look, I don't know all the details, and my bet is there's a lot more than what the headlines say, that the fine print is really important. But I think getting together is the best thing for golf. This fight that was going on and the lawsuits that were raging, and one side, the golfers from LIV, and taking shots at the PGA and vice versa, that's not constructive for the game. Golf for a while was very flat years ago. Tiger Woods got into the game, and all of a sudden, the number of participants in golf increased by 2-3 million participants. And then it started back down. So the worst thing, yes, it sort of makes interesting reading, but it is not constructive. So I would say this is constructive. As I say, I don't know all the fine print, the details, but I'm very happy that they've gotten this behind them. You've got some very capable people on the PGA side that are on the board there, headed by Ed Herlihy, and Jimmy Dunn's on that board. They know a lot about golf, and they're deal makers. They know how to get things done. So when I saw the headlines come across, I couldn't be happier that this is, I hope, now behind us, and we're going to be able to go forward with the game of golf. Because the game of golf is not just what you see on the TV or just at the pros. It's all of us that go out on weekends and get a chance to knock the ball around.
And as you reflect on where you are, I mean, we talked a little bit about succession, we talked a little bit about what you're doing. What energizes you at this point from a business perspective or even personally? I mean, this is a pretty remarkable chapter that you've entered into.
Well, I happen to love where I am right now. First of all, I'm asked from time to time, so what drives me? Well, for years, what's driven me, and today it's exactly the same, if not even more so, is curiosity. I don't think that anyone can be a great investor unless you're curious. But you got to be curious about a lot of things. It's not just the stock or the stock market. If I took people to the window in our office, and we go from 74 to 80, and said, look out, what do you see out there? I hope that they would say, I see possibility, as opposed to, I see the tugboat in the Hudson River. You've got to see opportunity and see where, connect the dots. And so what drives me so much today really is curiosity. I'm spending a lot of time, which I've done since 1998, but I did it out of my back pocket, in the venture startup world. We didn't do it at KKR, so I was able to do that. Today, I built that up significantly and having a lot of fun meeting with young companies, entrepreneurs, et cetera. That's fun. Secondly, I'm very involved in an organization called Sponsors for Educational Opportunity, SEO, and that's critical for me. It's helping the underserved community get a good education from 9th grade through college, so it's an 8-year program. So I spend a lot of time on that. And I'm still very involved at KKR. In fact, I'm as busy today or busier than I've been, except I don't have to worry about all of the detail day to day.
Sounds like a pretty good job.
It's a great job.
All right. Thank you for spending time with us. Please help me thank Henry Kravis.
Thank you.
You've been listening to Henry Kravis, KKR co-founder and co-executive chairman at a Bloomberg Invest conference with Jason Kelly. You can also look at all the panels from Bloomberg Invest on your terminals on Live Go. We're going to have much more over the next couple hours. It's truly a powerhouse lineup of guests. Guy, I could actually listen to him talk all day, just like the decades of experience that he's had, and then how he winds up seeing the market right now. Particularly as the transition has been somewhat successful at KKR. It's quite interesting.
Yeah, it's all about culture. Got to get the culture right. You want to do business with people that you know and respect. That was one of the takeaways, I think, from what he just said. I think we all know that. But the fact that he continues to apply it, and always let your cousin ride your new bike first. That's how relationships are formed. I don't have any cousins. I'm an only child, so I got nothing. I got totally nothing. But I hear that they can be nice and fun. Cousins, yeah, well, they can be occasionally, as long as you let them ride the bike first. Right, otherwise you got to do that, and then or else there's violence. In your head. But his talking about relationships, I think, is really important, and the fact that he talks about how important culture and relationships are, I think, speaks to the longevity and why they've had such longevity and success. And they talked about the next generation coming through and having that same cultural fit with the firm, I think, is so important. And I think that's where so many companies struggle. That's where so much M&A struggles. It is about fit and culture and relationships. and making those all fit together. And if they don't fit, don't do it. If they do, there's an opportunity.
Yeah, and that's what you're saying about M&A too. Like, right, you just brought it up. For example, the deal flow is definitely slowing down. For example, and that's going to be sort of a nice setup for the next couple days, and we have Bloomberg Invest, right? The deal landscape is really tough.
Yep.
So what do you do when you make money off of deals?
You hunker down, you wait, you get creative, you get curious, you see what's going to happen next. I've just been talking to a load of airline CEOs. It's interesting to hear them talk about the fact the business travel hasn't come back as much, which maybe is also a factor in all of this as well. People aren't traveling as much, they're not meeting as many people as they once were. Maybe they're doing some of those meetings over Zoom. But it's interesting, we're going to talk to Investec a little bit later on as well in the show. Investec doing a deal today. You've got this whole kind of large companies hoovering up smaller companies because there's a deal drought right now, so there's consolidation happening in this space.
Yeah, I was talking to somebody the other day that said that their travel is down 70%. Pre-pandemic, and everyone's fine with it. Anyway, so let's get more news of what's going on right now. It's 21? Yes, 21 minutes past 7 on the West Coast.
We're on the nose.
We're on the nose. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. Silicon Valley starts this morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. It's West Coast, but it also kind of is East Coast because we're going to have the Coinbase. It's everywhere. It's everywhere. We're going to have the Coinbase CEO on Bloomberg Invest panel at noon. What are some of the questions that we're all going to be thinking about? I mean, does Coinbase sue? What do they do?
Well, I'll make a really quick point, if I may, Alex, that remember during the pandemic, February 2021, Coinbase was a San Francisco headquartered business, but it decentralized itself and sent all of its employees out in the world with the freedom to work remotely. So I would have started the startup segment by saying, yeah, everyone in the Bay Area is watching for that reason. Loads of employees are still here. But they are watching because it is US listed, and for Coinbase, the US is the majority of its business, right? And if you go on the Bloomberg terminal this morning and read just brilliant reporting and tech columns, they frame this as life or death. And there's one particularly excellent piece, which is what we will ask Brian Armstrong about, which is 2 years ago when Coinbase filed with the SEC, they pointed out in the regulatory filings, I'm just going to read it because I don't want to get it wrong, that there is a high degree of uncertainty, quote, regarding the legality of its operations, and it warned that regulators may disagree, quote, with the company's view that it is not covered by SEC rules. And that is what the SEC is saying here, both to Coinbase and Binance. You are peddling unregistered securities.
And that's the common link, that's the link between the two. Is it by accident that we have Coinbase and Binance in the spotlight at the same time? It's come one after the other, and you have to assume that there must be some sort of connection. Am I overreaching there? Is there a connection?
24 hours ago, we had Gary Gensler on the show. His comment seemed really simple to me, which is that this is, to the SEC's mind, a classic breach of securities law. It just happens to be in the crypto context. The timing I don't have an answer for. And I think that, in the conversations we have out here with venture capitalists that back startups in this industry or that invest in tokens specifically, they see this dragging on for months, right, until we reach some kind of conclusion. I think we've got the tweet that Brian Armstrong put out yesterday, 24 hours ago. He's welcoming the opportunity to basically go to court, represent the crypto industry, and say, this is how our business works, and debate the legality or merits of it. It's fascinating, the timing. And, Bloomberg Sonali Basak, I hope she asks, why now?
I'm sure she will. What I also found, and first of all, if you ever want to get super in the weeds with this, you have to read Matt Levine's column. He does great deep dives into Wall Street every day. And in his column that he broke down yesterday, Ed, he made it really clear, and I loved how he's able to do this, that Coinbase and Binance did the same thing but did it differently, and this is where I think the rubber's going to meet the road. When it comes to Binance, it's like more opaque, right? Like, where are they headquartered? Where do they go? Where's their money kept? Not necessarily saying that's anything sketchy, but that's how they wound up dealing with it. Coinbase is like, we're pretty sure we know that at some point we're going to get sued and that this is illegal, but we're going to put all these rules in place, get this big lawyer team to be able to counteract that when the lawsuit comes. And I'm wondering if we're going to learn at any point which one's right.
I mean, the legal experts which we interviewed for the Bloomberg reporting this morning basically make the simple case that Coinbase is US listed and the majority of its business is in the US. The latest news is the SEC last night filing a temporary restraining order against Binance, particularly for Binance US, to freeze assets. And in Binance's case, they accuse Binance of commingling, right? Taking US originated funds and moving them to other Binance businesses. And in Binance's business outside the US is much bigger. That doesn't really answer your question, Alex, but that's the complication here. The access to information on Binance.
What did the regulators learn from FTX that they're applying here?
That's a really hard question. They learned not to judge a book by its cover. You know, Sam Bankman-Fried painted himself as the good guy of the crypto industry. And, you know, that process is ongoing, and we're learning, you know, the actions that he as an executive in the business took. The US regulators at least disagree with that. But CZ and Binance did very much the same thing. You know, CZ and Binance have faced regulatory headwind for a really long time and have been able to operate in multiple jurisdictions. This is the US. This is the big one.
Yeah, FTX feels like such a long time ago.
It does.
Ed Ludlow, looks like it may be coming around again. We'll see. Ed Ludlow, Caroline Hyde, a little later, Bloomberg Technology, Brian Armstrong. This is Bloomberg.
We're about an hour into the U.S. trading session. Stocks really going nowhere. You are seeing a sell-off in the bond market. You can kind of look at Bank of Canada for that hiked 25 basis points at the top of the hour. Bloomberg's Abigail Doolittle tracking those moves. Abigail?
Overall, Alex, a whole lot of nothing. Take a look at this S&P 500 E-mini chart over the last 3 days. Today we have the S&P 500 doing nothing, but we have up and down, overall up ever so slightly, up about 0.1%. So investors taking in all kinds of information, and right now just sort of whipsiding, turning, not going anywhere. As for some of the other asset classes on the day, take a look at the VIX. It's up slightly, but a 14 handle. That speaks to the complacency that we just saw in that chart as investors wait for new information to make a directional move. The 2-year yield backing up in a big way. So this is really where the move is on today. Bond selling off with that 2-year yield closer to 460. Once again, crude getting a bid up 1.5%, and Bitcoin down 1.2%. Lots of volatility there. This, of course, is the SEC is cracking down. If we take a look at some of the crypto-related stocks, we will see. I'm going to be curious to see what we see because there's been so much volatility. Coinbase right now up 1.6% after falling 20% on the week in sympathy with Binance, the lawsuit by the SEC against that company, and then their own lawsuit that was filed against them yesterday relative to saying that the exchange is illegal and that the SEC has domain over tokens. You can see in sympathy down also, not in a big way, but down over the last, from the peak, down an incredible amount. Coinbase down about 86%. There's a big short interest there. So investors have been worried. If we connect this to Bitcoin, there's an interesting divergence that is building because on the year, Coinbase kind of in a range. But again, over the not so long term, it is down sharply. Take a look at Bitcoin, though. It's having a big rebound this year. Started trending a little bit down to the downside, but holding support right now on the year up an amazing 61%, although then again, Guy, this is Bitcoin, so 61%, it's impressive, but it could be bigger or smaller.
We've definitely seen bigger. We've definitely seen smaller, but as you say, it is a pretty whippy market, unlike everything else at the moment. Though I have to say the 2-year getting moved by the Canadians. I know everybody always says the Americans are always very dismissive, Alex, of the Canadians, but they're giving New York City lots of smoke, I understand, at the moment. And a rate rise, 25 basis points. Look at this.
Yeah,
11 basis points on the 2-year. That is a chunky move. That's a decent sized move and must portend the market's view on what's going to happen with the Fed.
So to be clear, this means that South Park was right and that you do have to blame Canada. That's the big takeaway from this one.
Well, I think blaming Canada may be the right choice today. Is it
Just
that
today.
smoky? I give you go outside?
Yes, it is. It's pretty bad. We're also just not like set up for this. So no apartment's going to have like air filtration systems like you'd have in California if you live in the wildfire zone. It's really bad. So I know that a bunch of people were masking outside. All schools, public schools, are not allowed to go outside today. They have to stay indoors. It's really bad.
So Henry Kravitz was saying he wants to stand and look out over New York City and would ask people what they would see. Today, I guess they probably wouldn't see very much. Not much opportunity out there. Just a lot of Canadian smoke and a 25 basis point rise. Anyway, we'll come back. We'll talk more about the Canadians a little bit later on. Should we be blaming the Canadians? Stan Druckenmiller, of the Duquesne family, office chairman and CEO, speaking at Bloomberg Invest conference about the future of AI a little earlier.
All of AI is not going to make it through whether we have a recession or not because they haven't separated the wheat from the chaff yet. But I do believe, unlike crypto, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like NVIDIA, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that NVIDIA goes down despite the lofty valuation level. History has proved if you have very good earnings in a recession and they're sustainable, if they're not, the market somehow figures it out, those stocks will do just fine. So we have some longs, we have some shorts, and the AIs have sort of dominated the long portfolio for 5 or 6 months.
When you look at the AI kind of boom here, are there lessons to be learned from the dot-com bubble?
Yeah, there are definitely lessons to be learned. Don't get emotional, don't get crazy. But I will say this about the AI. NVIDIA bottomed in October in the low 100s. It's true it's 380 or 390, it's in nosebleed territory. If this is a secular move, if this thing is real, you just don't have 10-month moves. That's not how it works. Even the dot-com bubble lasted 2.5 years. For many of the guts of the internet, it lasted 4 years. The Cisco's, the Sun Micros. So could NVIDIA go down materially in the short term from any point? Yes, but I would be surprised if I'm right on AI and the impact on it. I mean, it's already making the top coders 7 to 8 times more productive than they were 5 months ago. If it's as big as I think it is, NVIDIA is something we're going to want to own for at least 2 or 3 years, not for 10 months, and maybe longer.
Maybe longer. Stanley Druckenmiller, Chairman and CEO of the Decane Family Office. Turns out the S is silent. Not according to me, but turns out it is. Anyway, he was speaking at the Bloomberg Invest Conference. You can follow that conference. There's some great panels lined up. Make sure you go and check it out, live go, on the Bloomberg terminal. Let's carry on the conversation and talk a bit more about what's happening with the AI story. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, joins us now. Margie, Stan Druckenmiller likes NVIDIA even at this level. What do you think? We've had a great run. We've had an incredible run. A lot of people are a bit nervous about how high some of these chip stocks have got. I read your notes this morning. You still like chip stocks. At what point do you say enough is enough?
Well, I don't think we're at that point yet. It's true they've had huge moves this year, but a lot of them, if you remember in the last half of last year, were way down. So they're just really recovering. If you look at them over, say, the last 12 months, they don't look so very highly priced. And even if AI turns out to be taking longer to actually produce profits for companies, there's still so many other areas of tech that have very, very strong growth, even during this period that we've had over the last couple of years. So we think the growth is still sustainable, whether AI comes sooner or later, or how big it actually is. So we still think tech is a good place to be.
Margie, what we have heard about, though, is that maybe the rest of the market will come up to tech rather than tech having to roll over, which kind of fits into your point. Are we going to see that? And if so, what comes up fastest?
Well, I think that will happen, because I think seeing how well the top 10 did with the first quarter earnings, the market gave a sigh of relief. Then it took the whole tech sector along with it. And I think you're seeing not so much in the style, growth, value, and so forth, but rather in industries that have some long-term characteristics. I think lately you've seen industrials, particularly those companies that will benefit from much higher capex and incorporating technology, even materials. And we've even seen in the last week or so, it looks like the banks are scrambling out of the grave, and maybe they're even recovering in value too. So we think sectors that have some long-term characteristics going for them are actually going to take up the lead here and move forward.
Alex, that's going to confound the market, because so many people are taking money out of this market right now. There's FOMO definitely when it comes to stocks like NVIDIA, but everywhere else, you look at the Bank of America data, people continue to take money out of the market. The flow is out, not in.
Well, yeah, and also the feelings are negative, even though you could look at equities relatively holding up. Margie, I wonder if you overlay the bond market on this one, because we're seeing a pretty chunky move in the front end, up by about 10 basis points. It's after the Bank of Canada went 25. Are we underestimating the ability for the Fed to keep hiking at some point, even if they hold in June? And where is that priced the least in the equity market?
Well, I think that the Fed is just about done with their tightening, whether it's June or July. I think that'll be about it, because inflation really looks as if it is decelerating, even though the economy is pretty strong. So we think that the Fed is pretty much out of the picture, and looking at the economy away from Fed actions, it's actually doing remarkably well. And if there's a recession, I think we have to keep pushing it further out.
Margie, there's a lot of money, to my point about cash, there's a lot of money sitting in money market funds right now. Should it be in money market funds?
Well, I think it's better to hold your breath, take the plunge, and look to invest in the equity market. When you have money market at 4%, it's very comforting to stay there, considering how low rates have been over the last decade. But really, the economy looks very good. The economy is hyper-competitive in the U.S., and there's no real imbalances that say we're likely to tip into a big recession soon. So I think it's a time to look at the equity market and take a more nuanced approach about where you want to be. But yes, definitely, I would not have a lot of cash in this market.
Margie, thanks a lot. We appreciate your time today. Margie Patel, Senior Portfolio Manager of Allspring Global Investments. And Guy, to your point, that's kind of the FOMO trade, right? Like you might not like the rally, but if you don't want to be sitting in cash, you feel like you need to keep putting it to work. And the higher we go, it sort of sucks in more money.
But it's only in the chip sector. So you've got this kind of weird situation where people are taking money out of the market. The flow is definitely out. But people are looking at stocks like NVIDIA going, I can't not. I've got to get in on that action. I just wonder where that leaves the market if suddenly tech rolls over. It's going to be in a very difficult place.
Yeah, well, that's why you need the other sectors to catch up and see that rotation, right? Instead of tech coming down to, say, the S&P or energy or discretionary, you need those sectors and small caps to come up to the NASDAQ. And you wonder if we're starting to see a little bit of that starting to happen. I don't know. Maybe too early to call.
Well, yeah. Maybe just a little bit, but 25 basis points from the Bank of Canada. RBA's back in the game as well. Maybe the Fed pushes on another 2. Maybe it's more than 2. What happens if the Fed feels like it actually needs to make sure that it is Vulcan, not Burns?
Well, also, with the Bank of Canada, we learned that January they pause and they hike again in June. It doesn't have to be just 1 month.
The gaps can be big. The gaps can be big. Basically, they've left a gap. And now they've realized they've made a mistake.
Yeah, so to that point, if you keep getting higher interest rates, what does that do to the housing market? You got mortgage applications earlier in the day dropping for a 4th straight week. We're going to get the view on the ground with Robert Retzkin, Compass CEO, coming up next. This is Bloomberg. One area of the market that's perplexing people is what actually is happening with housing. Are we reaccelerating? Well, we got U.S. mortgage applications falling over the fourth straight week. Earlier today, we're seeing 30-year fixed rates close to 7-month highs. Plus, you now have a chunky move in the front end of the bond market, up by 10 basis points. Joining us now for more on the housing market is Robert Refkin, CEO of the real estate brokerage firm Compass, which is huge, particularly here in New York City. For me personally, I'm on that stuff all the time. So, Robert, if we do wind up getting sort of a pause and then more hikes from the Fed, and we sort of push higher here like what we just saw from Bank of Canada, what's going to be the knock-on effect from the housing market? Is it resilient? Is it not?
I think it's resilient up into 7.5% mortgage rates.
Really?
Buyers have accepted 6-7% mortgage rates as the new normal. There's more buyers than sellers. Prices have actually increased every month this year and are near all-time highs. The issue we have in the country for real estate is there's just not enough inventory. And that's because 30% of homeowners are locked into mortgage rates of 3% or below, and 70% of homeowners are locked into mortgage rates of 4% or below. And if you have a 3% mortgage rate, you consider that a financial asset and don't want to lose it.
No kidding.
Okay, Alex Steele is the perfect example here, okay? Would Alex Steele ever move house given the rate that she got? How do you fix a market where nobody wants to give up this incredible rate they got a couple of years back, Robert, to move home? Yeah, how do we get around this? Is everybody just renting their houses out? What's the story here?
Yeah, I call them golden handcuffs. The good news is you can only hold back life events for so long. People get married, they have a kid, they have a new job, they have to return to an office. They don't wish this on anybody, but there are deaths and divorces. So that's keeping a natural level of inventory, although low, but enough to keep the industry moving.
Right, and Guy, what you're talking about is my 2.75% 30-year fix that I got over the last couple of years. And it's exactly right. We talked about this before, that I'm either going to have to get fired or get divorced for me to give up that apartment.
Well, I guess, but what Robert's saying is the strategy is that maybe people rent their houses out. They don't sell the house. Basically, you go and get another house, you rent the one you're in right now, which has got the great deal on it, and you suck up the new rate, but you don't lose that initial rate. So how are people getting around this? Robert, is this just a different market now? Is it structurally different because people are refusing to sell?
You're correct. This is a different structural market. We're seeing more than ever before people that have to move, they're moving to a new city and holding their apartment, renting it out, and taking the financial arbitrage between market rents and their low mortgage rates. There will be a time when a flood of inventory comes back to the market. I believe that will be when mortgage rates are closer to 5.5%, because if you have a 4% mortgage, you don't want to roll that into 7, but you'll roll it into 5. And so I think that will be the natural moment when a lot of inventory comes back to the market.
So to that point, then that's obviously why new home sales have been really strong, whereas existing home sales are kind of flattening out or rolling over a bit. It's a supply, not a demand issue. Do you feel like if you look at the housing market, we are re-accelerating or just not de-accelerating?
I think it's a sideways market.
Okay.
Until we see mortgage rates go sustainably below or around 6% flat, I think it will continue to be sideways. The silver lining, I think there are two pieces of silver lining. One are prices have gone up, so developers are starting to develop again. For the first time in over a year, the home builder sentiment index will turn positive. And that's a monthly index of home builders on their desire to build more inventory. The second is we're seeing an extension of the spring market. Compass, we're the #1 brokerage firm in the country. We have nearly 30,000 agents in all the major markets in the country. And so we can see from those conversations that buyers, they can only hold back these life events for so long that they're extending their purchasing beyond the traditional spring market.
Do you see this market going back down, Robert? Here in the UK, we just had data today that says for the first time in many years, we've just had a year-on-year contraction in the housing market. Are we going to see significant pockets within the United States where that also becomes true and maybe lasts a little longer?
Well, when you talk about the market, there's units and then there's price. On units everywhere, it's declined on a year-over-year basis. On price,
prices?
On price, the places that went up the most are getting hit the hardest. So take Boise, Idaho, Austin. I think Places like San Francisco are challenged in that respect. However, that's where there's a lot of opportunity. If I were trying to make a financial investment, the place that I would go right now would be the downtown condo market in San Francisco. And that's because return to office is going to come back to every major city in the country, I believe. But San Francisco is the furthest behind in that trend. You can see what just happened in Seattle a month ago. Amazon brought back thousands of people, and the downtown condo market in Seattle took off. The same thing will happen in San Francisco.
It's great to see you, Robert. Thanks for stopping by and seeing us. We really appreciate it. Robert Reffkin, Compass CEO. I want to take you back to the Bloomberg Invest Conference. It's taking place in New York. Sasundra Brown-Duckett, President and CEO of TIAA, is speaking with Bloomberg's Sonali Basak.
And then lastly, I think we cannot have this conversation without talking about education. How do we make sure that we are informing and taking the opportunity to educate our employees about the benefit, about what does it mean to have a secure retirement, and to make sure that they understand that making sure that they are secure puts a less burden on their loved ones that they care about. So there's a really important role that we play in business. And then finally, policy. I think in the business community, we have to continue to encourage Congress, to encourage the federal government to operate in a bipartisan way, to continue to provide solutions that can make it easier for the average American and easier for business to make sure that people can be on a path to a secure retirement.
You know, we started this conversation off talking about that stat that 40% of Americans run out of money.
Yep.
And if you look at the stats, the real survey here that is coming out, most people in the audience believe that there will either be aftershocks and inflation or that new problems are coming.
Yeah.
What makes that 40%, 50%, or 60% or even more? I mean, are you worried about the direction of travel here?
Yeah, I mean, I'm definitely worried, but I also have optimism because we're in it for the fight. You know, we are committed to making sure that we can do our part to improve the outcome. But when you look at these stats, you have to be concerned because if we continue to have a high inflationary period, if everything continues to cost more, if wages are not keeping up with the cost in the rise of inflation, then the average person has to make decisions for the short term that can have longer term implications. And so I think it's important for us to continue to make sure that we're looking at the after potential effects of inflation. I think we absolutely have to make sure we're not just thinking about the here and now, but what are people doing and what are those behaviors that people are acting today and what can that mean in the long term, because we will have a crisis in our country if we are not making better decisions today to make sure that people can have all the solutions and the tools that they need to retire.
I want to talk a little more about some of the hot button issues in the market as well, because I know that you have a pretty nuanced takes to them. We've been talking so much. Everyone's going to be talking about artificial intelligence today, let's be honest. But you know, when you think about how you're running your business on it, TIA is a private company, what are the ways you're using it, and what are the ways you're most concerned?
I mean, AI has been here. It's here, and it's only going to continue to grow in terms of what it means to business. The way I think about it is I think the way that many of us think about it, clearly the benefits of AI is improved productivity. There's opportunities to make it easier to delight the client experience. There's ways to be the companion to the employees that you have so that some of the baseline work can be not what they have to focus on, so they can work on, you know, higher complex issues, and making sure that you have a reskilling program in place as you think about the jobs of tomorrow. But I also think, given that we are a long-term investor and given that we are working with participants all ages, all the way through the transfer of wealth, we have to be concerned about risk. And so I think as we continue to invest in technology, as we all continue to get smarter about AI, I think it has to run a parallel path to really running what are all the risk scenarios. I think the investments that we make in technology, whether it's cyber or other risk tools, cannot just be the protection of yesterday's risks. It's not even enough to make sure that you're investing for the today's risk. We are making investments to thinking about tomorrow. What are the implications of ChatGPT? What are the implications in terms of account takeover? What are the implications in terms of imposters coming in and they sound like your daughter, they know your behavior, and then they're taking your money? So I think there are real risks that we have to make sure that we're focused on, while we also are taking advantage of what the advantages of this technology can mean in terms of the company that, you know, that I run.
How often is some of that actually happening right now?
I mean, it's here. I mean, cyber risk is a real risk. When you think about fraud, when you think about people wanting to take advantage of the elderly community is one of the sectors that are most prime for abuse. And so making sure that we're communicating with our participants, making sure we're communicating with their loved ones. This is a risk that's happening today. And the risk will only become more amplified as we think about the sophistication of technology. And so that is why I think it's important that when we're having the conversation about AI or any technology, especially in the investment community, at the same time we have to have the conversation about risk to make sure that we are doing both, taking advantage of what can be good for business, but it's not good if it's not protecting ultimately who we serve.
Cassandra Brown, Duckett, President and CEO of TIAA, speaking to the fantastic Sonali Basak at the Bloomberg Invest summit that's taking place. You can watch the panels, carry on doing so. They are fantastic, as you can see. They're available on your Bloomberg. Live Go is where you're going to find them. Quick market check just to show you what's going on. The Canadian rate rise is certainly having an impact on the rates market on both sides of the Atlantic. Let me focus on stocks as well for just a minute. Stock 600 down a little bit today, but there's this huge retail bid that's in the market today. And when I say retail, I mean stocks like Zara. Inditex, the owner of it, absolutely flying today, up by 6%. The numbers are really good. Zara's having a really good time of things. People are buying, and they're buying big in big stores, and that's really helping the story. The other thing I want to mention as well is what's happening with the Turkish lira. Turkish lira down hard today, the dollar up by 7%. Turkish banks are backing off, supporting the Turkish lira. Got a new finance minister. Remember, I just got back from Turkey. There is no connection with my return and what we're seeing here. Anyway, coming up on the European close, Ruth Lees, Investec Bank CEO, is going to be joining us. They've just done the deal in the UK. The deal is about the fact that we're seeing an M&A drought. We're going to figure out exactly what that means. Will we continue to see consolidation in this space? That conversation in the next hour. This is Bloomberg.
Wednesday, the 7th of June. Stocks are boring, nothing happening. Look at that, a lot of grey on the screen. Turkey's up, but the lira is down. That's why that is happening. It's a mechanical process. The bond market looks pretty fascinating, as does what is happening below the surface in stocks. Inditex having a really strong day today. We'll talk about the retail story in a moment. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Stock 600, boring, nothing to see there, so let's move on and talk about what is happening with single stocks. Inditex up by over 6%. People are going to Zara stores, they're spending money in big Zara stores as well, which works even better. The numbers today were sensationally strong. The market rewards it. Who says the consumer is out? Certainly not Inditex at the moment. Very strong story. Retail by far and away the best performing sector in Europe today. Take a look at 888. There's been a lot of heat around what is happening in the gambling sector, both sides of the Atlantic. This stock is up by 25%. There is a sense that maybe it's underperforming. There are those that certainly believe that. So what you've got is a whole load of older investors in this space that have decided that they are going to take a stake in this business and they're going to figure out what to do with it. One of them may end up with a board seat on 888. This is William Hill. The stock is responding really positively, up by 25%. So stocks are boring. The bond market's not boring today, Alex. The Canadians are making their presence felt.
Yeah, no, definitely not boring when it comes to the bond market. A huge sell-off in the front end led by the Bank of Canada actually raising by 25 basis points after a 6-month pause. I just want to skip to the end here. You can see the 2-year yield up by 11 basis points. If you skip 1 month or 6, doesn't mean you can't still hike. The S&P a touch softer, but really not a lot to see here. What is interesting, though, is what's still leading in the market. Consumer discretionary and energy, small caps also doing really well. Are we seeing those sectors kind of catch up to the growth of the AI trade and the overall tech industry? The VIX at 1.13 handle, the lowest level we've seen since 2020. Talk about like nothing to see here. That volatility might make you think that maybe you do want to get back into the market. But the S&P down by 0.1%, Guy.
Lots to talk about when it comes to the Bloomberg Invest Conference. Wow, what a great lineup of guests that we have had at this event. It's underway in New York today. Dawn Fitzpatrick, Soros Fund Management CEO and CIO, is speaking with Bloomberg New Economy Editorial Director Eric Schatzker.
Who are citing this asset class as cheap. When something's cheap, I want to know why it's cheap. And again, there's some really clear technical reasons why this asset class is cheap. And by the way, I think you're going to see more bank failures, likely in the small banks. So it's not going to be the big headlines and the size of the failures we had so far. But I think there's more problems under the surface. So you'll see continued sales. And the other thing that is undeniable is in aggregate, banks have to reduce balance sheets and shorten duration of portfolios here. There is, regulation coming that's going to be pretty punitive.
Talk a bit more about that.
Yeah, so I think, the Federal Reserve has said they're doing a comprehensive review of bank regulation. I think what that's going to look like is enhanced stress test. AOIC exemptions, I think, are going to disappear. That's where people didn't have to mark things to market. I think when it comes to liquidity management, there's going to be a lot more scrutiny on that. One of the interesting things is coming out of the financial crisis, there was a lot of focus on asset quality, so things like stress tests, and not as much on liability management. But now we know, deposit assumptions were just wrong. And by the way, I won't mention the name, but a bank yesterday said they lost one of their biggest depositors because another bank was paying Fed funds plus 70 basis points for deposits. That's not a healthy backdrop. And by the way, part of the reason they can do that is because you have a quasi-government guarantee right now on bank deposits.
So in addition to agency mortgage bonds, what other kinds of trades and or investments seem attractive to you with that as the backdrop?
So we're finally, with that as the backdrop, you are seeing a credit contraction. I think, the recent loan data, doesn't actually surprise a little bit better to the upside, but this contraction is invariably coming. Banks will just be able to loan less. In the levered loan space, 70% of levered loans have been bought recently by CLOs. CLO issuance right now is at 2020 levels, and also typically CLOs have a reset where they can extend duration, but this is another unintended consequences of higher rates. Now with higher rates, those resets don't make economic sense, so you have 40% of existing CLOs ending their reinvestment periods by the end of this year. So you're just going to have less credit available. And there's a lot of people who think, private credit has grown exponentially, they'll just fill in the gap. I think that's not going to prove to be quite accurate. They can do more than they could have done 10 years ago, but it's too big a gap to fill in. So in private credit, we're finally seeing things begin to reprice. And I think you are going to see a default cycle that is about to kind of emerge. And I think the magnitude and probably more interesting, the duration of that default cycle is going to surprise people.
How do we see that play out then? There's clearly a bond market, there's a leveraged loan market, but there isn't much of a secondary market for things like the unitranche loans that have been, that lately have been dominating the growth of the private credit market.
Yeah, so again, I think private credit firms are all opportunistically trying to raise capital. I think when you look at alternative asset management capital raises, they're generally challenged. Maybe private credit is a little less challenged than other areas, but they're all challenged. I think in the private credit world, one of the things you're going to see is the most vulnerable loans are going to be the ones that private equity took out, so sponsor loans. And I think you're going to see those private equity companies be really aggressive around liquidity and maturity issues. So I think you're going to see a lot of kind of extend and pretend, and that also reduces the amount of real dry powder out there.
For you, is this just a matter of waiting for the things that you find interesting to get cheap enough, or are there opportunities to short along the way?
Yeah, so right now our balance sheet is really clean, and one of the things I've been stressing to the team is it is a little bit about being patient, and I think sometimes that's something that investors do poorly, both institutional and retail, is just be patient and let the opportunity set come to you. I think where we're headed, in some ways, the great financial crisis and COVID were not that painful, right? Because they were really deep corrections and really quick recoveries. I think this is set up for something that's going to take a really long time to play through. I think there's a lot of private equity and borrowers and people who own big buildings who are betting rates come down quickly, and that I don't see that happening.
Do you not see it happening with enough conviction that you're willing to take the other side of the rate trade?
We have that bet on in rates for sure, and I think one of the things that's different about this time is you had central banks and fiscal authorities throw everything, their entire financial crisis playbook, plus $6 trillion at the pandemic recession. In hindsight, it was too much, and it caused just overly abundant credit and asset inflation. And the workout on the other side is just going to take a really long time. And what we see is you still have a lot of underlying distortions. So like within sectors, you have like boom bust cycles. So at the surface, things look good, but below the surface, like all hell is breaking out. But think about that. That's going to make the Fed's job really, really difficult. And you could have a really big default cycle without GDP rolling over.
Much of this, Don, as you just alluded, is the consequence of policymaking, both at the fiscal and monetary level. How much confidence do you have in market regulation right now? When you see what's going on in crypto, for example, over the past couple of days, and folks, I think you're going to hear a little more about that in a few minutes, but also in antitrust.
Yep.
You mentioned banking.
Yeah, so I will start with crypto, which always gets me into trouble. But but I think, you know, especially the headlines of the last couple of days, it's clear these crypto native platforms would have benefited from having an adult in the room.
Somebody might have something to say about that.
To state the obvious, but like there are just long held and simple norms about how you treat customer assets, for example. And what I think crypto is here to stay. I think what's happened is clearly a setback. But right now, I actually think it's a huge opportunity for the incumbent financial firms to actually take the lead.
The ones that are already regulated and run, for example, regulated exchanges.
Yeah, and know how to segregate client assets and yeah. So I think that is what's going to happen.
Wouldn't that be ironic, though, given the disruption that crypto promised?
Yeah, there is some irony to it, and I'm yeah, it is ironic, but I think that is going to be the evolution. In terms of hedge funds and private equity, you know, when I look like at the Financial Stability Oversight Committee, which sits on top of all of the U.S. kind of regulatory apparatus, which our U.S. regulatory setup is really too fractured to be wholly effective, in my opinion. But when you look at what they're focused on, it's clear that they know post the financial crisis, because of regulation, they shifted an exponential amount of risk into the non-regulated, non-banking sector, and they're trying to figure out ways to get out that, because that is where your next systemic risk is going to occur, and their ability to spot it and course correct right now, I think, is pretty limited. So you see things coming out like the amendment to Form PF.
Mm-hmm. Where they have to alert the SEC to so-called trigger events?
Yeah, in very short duration. I actually think...
72 hours, I think.
Exactly. And I think in a lot of ways, that design is better than in 2011, Form PF just asked for this huge data dump that candidly, I'm not sure the SEC knew what to do with. So this alert system, I think, is really interesting and like elegant in its simplicity. But I worry it will allow them to see idiosyncratic risks and probably help those. But when it comes to systemic events, I think they might see it, but they're going to see it too late.
So a systemic event of what nature? That, you know, the highly levered multi-strategy hedge fund, you know, all of a sudden has serious problems?
Yeah, so if you look at the top 4 public market hedge funds right now, their balance sheets, their gross assets are well in excess of $1 trillion. And again, you have your regulated dealer community where the balance sheets have done nothing but go down. Another stat that's really interesting, your publicly traded alts, assets under management, have doubled since 2020. So in other words, and I would argue those big multi-strategy platforms, they don't do things that are all that different from one another. So when you have an unwind of a trade, finding that marginal buyer, I think, is just going to be that much more difficult. It's one of the things at Soros Fund Management we think about every day, in that we think we want to position ourselves to take advantage of those dislocations. But by the way, you saw it on the back of Silicon Valley Bank failure when you had 2-year treasury rates go from like, above 5% to below 360. That's like a crazy enormous move for a 2-year government bond.
There are any number of different kinds of dislocations. We've talked about some of them: technical, structural, cyclical. There's technological too.
Yeah.
Do you think AI is going to create market disruptions, dislocations?
Potentially. I think, when we see what's going on in AI, first of all, when you look at what just came out of the recent earnings report, it is clear that we're at the beginning of a mega cycle in spending in AI. And the real beneficiaries obviously are the applications, so your SaaS companies, and infrastructure, so it's cloud and your high performing chip companies. Those stocks right now are extrapolating pretty enormous compounding growth. We wouldn't necessarily chase that, but to your point, what's really striking about where we are right now is AI allows us to talk to computers like ourselves, and the ability to tap into massive compute power, and probably even more importantly, enterprise data and just global data generally, is going to be seismic, and the capabilities are just going to be exponential.
Don, last question for you. There's a long tradition of prominent investors who speak out about economic policy. And much of the commentary we get from them, I think, is genuinely altruistic, right, out of concern for the good of the country, or perhaps even the good of the world. And George Soros is near or at the top of that list. Also Stan Druckenmiller, who was here earlier, who once held the role that you hold now. Ray Dalio, Ken Griffin on occasion. We get it from Warren Buffett, Bill Ackman, Paul Tudor Jones, whom you know well. They're all men. I'd love to add a woman to that list. Will it be Don Fitzpatrick?
Hopefully one day. Yeah, George is active, and I think it's important that I'm deferential to him. I do serve on government advisory committees, so I try to be
working behind the scenes.
I try to work behind the scenes, but yeah, one day.
Ladies and gentlemen, please join me in thanking Don Fitzpatrick.
You've been listening to Don Fitzpatrick, the CEO and CIO of Soros Fund Management, with Eric Schatzker. That was a great way to end the interview. Maybe one day. We will definitely look forward to that. You can follow all the panels on LiveGo on the Bloomberg Terminal. We will definitely have more panels for you throughout the day as well. I just want to go back to what you said about the mega cycle. In the beginning of a mega cycle in spending on AI, I was at a conference last night and someone brought up the fact that this is like basically shining an old penny. Like, AI has been around for a long time. It's being used in many things that we use today, but we're reshining it, we're reformulating it, and now it looks real pretty.
Yeah, I'm not sure that completely holds though. Yes, AI has been around for a while. The internet was around for a while, and then it had a really big impact. It takes a while for these things to gain momentum, to gain traction, to gain the kind of velocity that we are ultimately going to see from it, and maybe we're getting nearer to that point, so therefore it's easier to understand where the value is. I think it's a big challenge. I don't know how you value these stocks.
Yeah.
I don't know what this stuff's going to look like in 1 year's time, 5 years' time, 10 years' time. We've just been hearing that at the moment they're kind of extrapolating to the moon. Maybe that's where they're going. I don't know. So I think it's a really difficult challenge to try and value this stuff. At the moment, you've seen a big move, and now everybody wants a bit of it.
Well, also I found interesting too is the idea that it's these really large companies that are able to funnel a ton of money into that. But if we look at like biotech and as example, you need the small guys who are really nimble, who can innovate really quickly. Will the small guys in this space be able to do that? Or is this just going to be the world of some seriously large players?
Well, the seriously large players, you could go to the seriously large players for this stuff. I think this is the next step here, which is that companies can find a provider that allows a partner that they can work with that allows them to harness their data and better understand the environment they're in, again, I come back to the aviation industry. I was just at a conference. People were talking about this there. The CEOs don't really understand it yet, but there was a bunch of companies there that are basically saying, we can do this. We can partner with you. We can take your data and give you a better understanding of how you improve your productivity, how you enjoy a better story when it comes to fuel management. The aircraft, you take a picture of the airplane on Tuesday and then you take another picture on Wednesday. Has the plane been dinged up in any shape or form? There's loads of ways in which this is going to work. And I think that's the next bit. But so where the value lies, I guess, is the challenge.
Yeah, but it was really interesting to hear Don Fitzpatrick talk about the fact that we are beginning a mega cycle in spending in AI. Anyway, we'll have more from Bloomberg Invest. This is Bloomberg. It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Simone Foxman. The global economy is set for a weak recovery, according to the OECD. The organization's latest economic outlook forecasts a 2.7% expansion of world output this year and 2.9% in 2024, both below the average in the 7 years before the pandemic. The OECD says the war in Ukraine, the shocks of COVID, persistent inflation, and the restrictive policies of major central banks are all weighing on the recovery. The caution follows a similar outlook from the World Bank. Elisa Mall, the chief investment officer for Michael Dell's family office, wants to diversify her portfolio. The firm is poised to absorb an influx of cash and stock worth more than $20 billion after Broadcom closes on its $61 billion purchase of VMware. The cloud computing company counts Dell as its largest shareholder. Mall says she'll use the proceeds to add more real estate to the portfolio and also expects to invest some in credit. The Turkish lira plunged the most in more than a year to a new record as traders said state lenders had halted dollar sales to defend it. The currency dropped about 7%, weakening for a 12th straight day, and has lost more than 12% since the second round of elections last month. And that's the Bloomberg Business Flash. Alex, Guy. All right, thanks so much, Simone. Okay, so you said that wasn't your fault. I hear you. Maybe it's the new economy minister. Maybe we're not going to be supporting the lira, and you're going to let a little more market action come in. But nonetheless, how was it in Turkey? What was your big takeaway?
So clearly inflation is having a really big impact. That has been something they've had to live with for really quite some time. There's still election posters kind of all the way around Istanbul at the moment. So we're still in the kind of period in which we're sort of digesting that election result. I think the people are digesting that election result. Are we going to get something different to what we got before? We were talking to Blue Bay just before the election, and they were saying, remember, he is a pragmatist, Erdogan. And maybe that's what we're seeing in the form of Şimşek, and maybe that's what we're seeing today in the market. Şimşek's basically come in and gone, we need to devalue the currency. And that is maybe what we're about to see. This is going to be a controlled, maybe uncontrolled process where they try and right-size this economy. It's going to be a really hard job.
Well, also, like, how much pain will be tolerated, basically? Yep. And then when will it not be? I'm really interested to see sort of that dynamic play out.
Yeah, I think the Turkish people have had a really tough time. And clearly the situation with the earthquake is something that needs to be taken into consideration when we're working our way through this process. But the loan market's beginning to tighten up. You're already starting to see that. You're already starting to see loans getting more expensive. And there is an expectation, maybe, certainly among some of the people I was talking to, that the rates are going to have to go higher. There is going to be a maybe more orthodox approach. But how long that lasts, I don't know. That's the critical question. Does Şimşek, is he going to be there for 3 months or 3 years?
So here's the big question. Are you airplaned out right now?
Maybe.
Oh!
I've got the Paris Air Show. The Paris Air Show is in 2 weeks' time. I'm going to take a little pause. This was the airlines who are really annoyed with the big aerospace manufacturers, Boeing and Airbus, because they can't deliver the planes and they can't get the engines. So the next bit, the Paris Air Show, is all about, where's my engine? To quote Alex Steele, dude, where's my aeroplane? what is happening here? And that's what the next bit's going to be about. Fixing the supply chain. The supply chain story is still massive in this industry. You can't get the aeroplanes, which means you can't get the cheap fares, because there's not enough capacity in the market.
Yeah.
We'll wait and see what happens. Alex, I think we need to talk about what is happening with some of these stocks. 52-week highs today on Inditex. Zara having a very good time. These are all the 52-week highs. Melrose is up, Alfa Laval, some of the industrials are up. Lotus Bakeries, I wanted to make some joke about things rising, but Lotus Bakeries is up by 2.31%. Nice numbers, apparently. Anyway, the close is next. This is Bloomberg. So Lionel Messi is not going to Saudi Arabia, he's going to Milan. I thought I'd start with something interesting because the stock market is boring today, certainly at a headline level. The Saudis aren't getting it all their own way. Golf, yes. Football, not necessarily. So that's the picture. The market is at a headline level boring, nothing happening. Turkish lira, there's a kind of mechanical process. The currency goes down, the stock market goes up. There are some big companies there that have international revenue streams. There's a kind of mechanical process that happens there. Everything else, look at this. The CAC is actually flat. It's 0.000. There is nothing happening here. The FTSE's not far behind. We are, I can't see if it's positive or negative, but basically flat. Nothing happening. The DAX is down by 0.2%. So yeah. The only market that's providing any excitement today is Spain. And that is because Inditex, which is a huge heavyweight on that market, is having a cracking day. People have been out shopping at Zara. Alex Steele, I'm sure, has not been because she has a budget. And as a result of which, yeah, that's the only interesting kind of major stock story. So here you go. We are on the stock 600 down by 0.1%. We're trading at 460. 461 is kind of where we are. We got briefly excited a little bit earlier on. The most exciting thing that's happened really is the Canadian rate decision. 25 basis points being added by Tiff Macklin and co. It was this month rather than next month. So that's the story there. Let's take a look at the sectors. Retail is by far and away outperforming. Energy's not far behind. These are Alex Steele's two favorite subjects. So we've got retail up by 2.5%. Energy is up by 1%, let's call it that. Basic resources not too far behind. In fact, this is the perfect, look at that, retail, energy, basic resources and real estate. Doesn't get any better than that. Bottom end of the market, healthcare, insurance, utilities, travel and leisure is where the weakness is today. But retail is the standout story. Let me show you why. Let me show you Inditex. Give you an idea of what is going on there. This is a huge heavyweight stock, and the fact that Zara is doing so well, the fact that the guidance looks so good, people are out shopping, the consumer has not been counted out yet. Inditex is up by nearly 6%. 888, you've got a cohort of very senior people within the betting industry getting together to take a stake, potentially board seats following. That's been taken well by the market. Danske Bank, cracking guidance, really good story when it comes to them returning money to shareholders as well. So yes, at a headline level, you may be interested in Messi more than the market. At a single stock level, Alex, there's plenty to talk about. Inditex, absolutely fascinating.
Yeah, and just a note on Inditex. I'm actually not shopping at Zara because of my budget. I'm not shopping at Zara because their sales aren't good, because they're very good at inventory management. I think that definitely speaks to, I'm just basically a nice funnel to understand what's happening in retail. Okay, let's take you back now to the Bloomberg Invest conference. The current panel is underway. They're talking about AI, the future of finance. Marty Chavez, Sixth Street Vice Chairman, Two Sigma co-founder and co-chairman David Siegel. They're speaking now with Bloomberg's Katie Greifeld.
Large language models are relatively new, and people are now trying to think of what are the most effective ways of using them. And we have such limited time. I don't want to talk about a deep dive or talk about things that people may know. But for example, large language models are pretty good at taking text and summarizing it. The summaries may not be all that reliable, but they can summarize things, and so that can be a boost to humans if you need a summary. And to be clear, large language models, you all know, they hallucinate, they give inaccurate information, so they can't really be used for a problem where you definitely have to get the right answer. So, if you want to, diagnose a health condition that you have, sure, you can type it into ChatGPT and you're going to get an answer, but, of course, not to believe it. You might use that as a starting point. Yes. So for applications where you don't need exactly the right answer, or it's okay that it could be completely wrong, and there are many applications like that, it'll be very useful. But just like with every other tool that's been invented, time will tell.
Well, Marty, come in on that, because we were talking about whether there's going to be 5 large language models or whether there's going to be 5 billion, and I'm curious to hear your answer to that, and also what the implications of that is.
So you would think, especially in finance, that we could make a tighter market than 5 at 5 billion. But really, as far as I can tell, nobody knows the answer. Are there going to be a small number of hyperscalers, Amazon, Google, so on, that concentrate these services? Because among other things, to train one of these frontier large language models requires clusters that are doing 25 exaflops. That's 25 times 10 to the 18 instructions per second, and they have to do that for months. And so that would argue for there being a very small number. On the other hand, there's been this notable release into open software of an LLM that Meta was working on, and now there's thousands of versions of them. I can't keep track. And the question is whether for specific applications will those be good enough, and then there will be 1 million or 1 billion flowers blooming. But back to your question on returns, I would say it's good for net returns.
Okay.
Right? So I don't know about gross returns, but it's definitely going to increase productivity. And there's a lot of agony about what it's going to do to investing jobs. There's one thing that I've experienced, I know David has experienced this too, which is over time, there's just more and more people working in our industry. But the skill sets have changed in a dramatic way. And what those people are doing is very different. So yelling buy and sell into a phone isn't really happening because the computers are doing that much faster. But there's still a lot of people. We have traders who code. And so I would give the same advice that I gave in a somewhat infamous town hall at Goldman Sachs in 2011, where I said there's really 3 stable strategies with respect to the computers, and I'd say this is true for AI as well. You can be a person who tells them what to do, and that's worked well for me. You can be a person who collaborates with computers and the people who tell the computers what to do. That's a great strategy for everybody. You can stand in the way of progress and hope that you keep your job forever doing exactly what you're doing, and that is really dumb, and you will be roadkill.
I think we all know some people like that.
You gotta get with it. So one of the things that I'm super excited about, just to say one last thing, is on David's point of summarizing docs, I'm actually pretty optimistic that generative AI is going to get more aligned and more constrained and more grounded in reality. So you'll be able to do cool things like, here's my 1,000-page limited partner agreement. Can you summarize it for me? And actually, can you give that to me in the form of a sonnet or a haiku?
Yeah. By the way, but I've of course done many experiments with various large language models, and I recently asked ChatGPT, I believe I was using that one, a legal question that I had, and it was question doesn't really matter, and it gave me a very well-reasoned answer, and I was quite impressed, and it was like a couple of pages long, and it cited various laws, and it reached various conclusions, and it was super impressive until I tried to validate it, and it turns out that everything it said only had a grain of truth, and so the whole thing was entirely wrong, but it was incredibly impressive. And so, you've all heard about hallucinations, but, try it yourself. And what you're going to see is that for certain classes of problems where the training data is of high quality and it doesn't have to do kind of deep inferencing, it's actually pretty good. But when it has to make, let's just call it conjectures, connecting things together that have less statistical oomph, it falls apart pretty quickly. And one of the reasons I actually philanthropically fund basic research in AI is that to really make progress in the field, in my opinion, it's not just about, for example, taking LLMs, the current state-of-the-art models that are being used,